Hi, and welcome back to the Business Career College video series. In this video, we're going to look at Canada Pension Plan, and specifically, we're going to look at the retirement benefits offered by Canada Pension Plan. You will you'll get a lot better appreciation for this if you watch the first video in the Canada Pension Plan series, the Introduction to Canada Pension Plan, or the Canada Pension Plan Basics, and that'll show you how the benefit is calculated, and it talks about the rate of contributions and so forth. In this video, we're very specifically concerned with retirement benefits. So the normal Canada Pension Plan retirement benefit starts at age 65. That's the normal benefit. Now, for 2013, the maximum is $1,012.50 per month. That's based on a calculation from the last 5 years, and this is how you always calculate the maximum. We take the last 5 years YMPE, and we're going to average that out. So just divide that by 5, sum that up, divide by 5. We get an average then, and then take that times 25%, and that gives you the annual CPP maximum. And that's how you would determine the maximum for a given year. And then we talked in the last video about how you actually achieve that maximum. So if you do happen to wait until 65 and you apply for your CPP then, your level of contributions will determine how much of that $1,012.50 you get. But it's not necessarily the norm that somebody actually waits until age 65. It's quite common for somebody to start at age 60. So if you do start at 60, there's got to be some consequence to this. So what we would do here is we say, all right, your benefit would have been, let's say, $900 a month. So let's say we have somebody who had a slightly smaller level of contribution than the maximum. This person would have had $900 a month at age 65, but now they're going to start at 60. So what we're going to do here is we're going to reduce the benefit, and the reduction works like this. We take the number of months that you're taking this early times, now I'm going to use 0.6% here. The reality is this is changing. It was 0.5% and it will be 0.6% by 2017. There's this sort of phased change that's happening, but we'll use 0.6%, and some exams still may be using 0.5 though, so you have to watch that. So watch for that 0.5% instead of 0.6%. So the number of months early times 0.6%, and the way you would get the number of months early here, is by taking, of course, the number of years times 12. And that's going to give you then your reduction. So let's say that we have somebody who is retiring at 60. So for that person, we can see that they're retiring 5 years early at 12 months a year at 0.6%. That would give you a 36% reduction. It's not always going to be 36%. If we have somebody who retires a little bit after 60 but before 65, then this wouldn't be 60 months. This would just be the appropriate number of months. So let's say that this person is going to be subject to a 36% reduction. We say 900 minus 36%, and that would give us $576. And if you have trouble with that math, there's a video that describes how to do percentages in math and so forth, so you can watch for that as well. So this person now has a $576 a month retirement benefit. And that's what they would have now going forward. Now this would be indexed to inflation, as are all CPP income benefits. But it's not going to get back, or they're never going to get back, that missing 36%. That missing 36% is essentially lost. Now, it used to be the case that you had to actually demonstrate that you were no longer working. We used to have what was called the work cessation test, and some of you might still be familiar with this. In order to apply for this benefit, we no longer have that work cessation test. That work cessation test is now gone. So we're done with that. So basically, once you're 60, you can apply for this, and whether you're working or not, you can still start getting your CPP then. Now, at the other side of that, if you decide to apply late, there's an incentive for applying late. And the incentive for applying late looks like this. Very similar here. We have somebody who would have gotten $900 a month at age 60. Sorry, 65, but that person decides to wait. So now we have a 0.7% per month bump. So we would take 0.7% per month, take 0.7 then times your number of months late, and that tells us what your increase is to your CPP. So this person, let's say, waits all the way to age 70. So that would be 0.7% times 5 years times 12 months. That gives you a 42% increase to your CPP benefit. So now you would have $900 plus 42%, and that's going to give you a $1,278 a month CPP benefit. Now you have to wait until age 70 to get that, or sometime between 65 and 70, we would do this calculation. And of course, that's also going to be indexed to inflation. And you can see here, there's some incentive now, and this is part of the intention of reforms to Canada Pension Plan introduced by the Government of Canada in 2011. There's some incentive to actually wait a little bit to collect your CPP. This person's going to have more than twice as much monthly income for waiting as if they start early. In a later video, we'll explore some of the math around the decision to start early or to start late. Here we're just looking at the actual concept of how much the benefit will be in either case. I hope that helps. Thanks very much. Hi, and welcome back to the Business Career College video series. In this video, we're going to look at Canada Pension Plan income splitting, and this is really a tax measure that's used only to reduce your overall tax burden. A very common type of exam question. There's a lot of little detail here. So we're going to assume that we have a couple. This could be married or common law, and they're both over 65. And let's assume that they married at a relatively young age. There are some limitations here. They both have to be eligible and collecting, or if one of them is under 65 and never contributed to Canada Pension Plan, we can have a split there as well. So both must be collecting, or it would be impossible for them to collect, would be the only reason that we could otherwise split this. So essentially, though, this is our rule. They both must be collecting it, and they can only split what they earned while they were together. So this is a little bit tricky. Basically, what this works out to is if you have a couple who marries later in life, so let's say you have a couple that marries at age 60, they wouldn't be able to split very much or possibly nothing of their CPP. But if you have a couple who married at a young age, they would be able to split pretty much all of it. Okay, so here's what we've got. We've got spouse A who's getting $1,000 a month from CPP and a bunch of other income. So in total, this person is at, let's say, a 40% tax bracket, adding up all of their income. And then we've got a person over here who's making $600 a month and is, let's say, at a 25% tax bracket. So spouse A is currently paying about 400 bucks, well, in fact, exactly 400 bucks a month in taxes. Spouse B, 150. Their total tax burden each month related to their CPP is $550. So simply by telling CPP you want to do this, it's not in any way difficult. You just have to tell CPP you want to split your Canada Pension Plan benefit for tax purposes. Canada Pension Plan will do that. Now I'm going to assume this couple has been together for a very long time and they earned all of their CPP while they were together so they could split it all. So that's $1,600 in total. Basically, we just take those two amounts and we put them into this bucket and we divide it in half, and now we can see that they're at $800 each. So now instead of paying tax on on 1,000 on the left and on 600 on the right, we're going to have A paying tax on $800 of income and B paying tax also on $800 of income. And I know that the tax would be done at the end of the year and so forth, but this is typically how an exam question like this will break down, where it will actually break it down to the month. So we take $800 times 40% and we get $320 here, $800 times 25%, and we have $200 here. So this becomes then a $520 tax burden as compared to $550 up here. That's $550 less $520. That's $30 of tax savings each month. And I know it doesn't seem like a ton of money, but all you had to do was check off a box on your return on your CPP application in order to take advantage of this very easy split. Now, while we're on the subject, this is also very similar to what happens when you have a divorce. So if A and B, let's say that we're a couple of years earlier, they're not yet 65, and they get divorced, we'd have a very similar calculation where we would take A's CPP credits and B's CPP credits, and we would say at the end of the divorce, they would have the same thing. They would have $800 each. So this would also be the outcome of a divorce. So the principle here is really that when you're earning a CPP benefit, when you're earning this benefit, you're actually helping your spouse out at the same time. So the spouses essentially share in all of this. They can share it in retirement, or they can, if it's unfortunate and it happens, they can have splitting on divorce as well. This is, in theory, automatic. If you let CPP know that you've had this divorce, they will automatically split this as long as you inform them within 4 years. With a separation, you have to apply for the split to happen. You have to apply within 3 years of the separation. I hope that helps. That's Canada Pension Plan income splitting. Just a little bit of a tax savings measure. That's really all that it does for us. And it is a frequent exam question on all kinds of financial services exams. Thank you very much, and enjoy your ongoing study. Hi, and welcome back to the Business Career College video series. It's Jason Watt again here. We're going to look in this video at the Canada Pension Plan post-retirement benefit. This is actually another one of the changes that was made to Canada Pension Plan in 2011. You'll recall from other videos in the CPP series that starting in 2012, there was no more work cessation test. So that means that you can have pretty much anybody over 60 now, or 60 or over, I should say. Let me fix that. 60 or over, and this person can be working and collecting CPP simultaneously. Okay, now this did used to be possible, but it used to be that you would have to have had a period without income in order to do this. The difference now is what happens if you are working and collecting CPP. You have then between 60 to 64, you must contribute to what's called the post-retirement benefit, which is sort of an augmentation to the CPP. It's part of the CPP program. And then if you're 65 or older and no later than 70, so this would stop at 70, then you may contribute. Now it is automatic that you contribute here. That is, you have to actually elect out if you don't want to do this if you're working. So this only applies to people who are still working. That's the absolutely critical thing here that often gets overlooked. If you're not working, then this isn't going to affect you. But if you are 60 or over, working and collecting CPP, this is where this is going to affect you. So now what happens is you do contribute to CPP at the normal rate. So between the year's basic exemption up to the year's maximum pensionable earnings, which we've seen in a couple of earlier videos, you're contributing at the normal 4.95% rate, and you're having both the employee and employer contribute again. So everybody's contributing. And what do you get in exchange for this? Well, what's going to happen is, let's say that this is 2013 and you are age about 62 and you have a $700 a month benefit that you're currently collecting. So you're getting $700 a month from CPP, and let's say that you contribute at the same rate that you've always contributed to. So your income is relatively unchanged. So you contribute at the same rate you've always contributed to this PRB. So you're getting $700 a month here, age 62. You contribute to PRB. So what's going to happen now in 2014, we say you're going to have about, and this is not going to work out perfectly in all cases, but this is approximately how this math is going to work out, and it's going to be very, very close to this, if not exact. So that's going to be 2.5% on $700. That's going to be $17.50 would be your PRB each month. So that gets added to your normal CPP. It's actually a separate check, or a separate benefit. So you're going to have your normal CPP of $700, and of course that would have been indexed. So we could have added indexation there if we knew what that figure was. And then you're also going to have your PRB, and again, as with all CPP benefits, that PRB is going to be indexed and it's going to be taxable. So now this person is going to have $700 of normal CPP benefit plus $1,750 of PRB. And if they continued working next year, then they would have an additional benefit. Then they would have $717.50, and they would get another 2.5% of that. And that would bring them up to about $18, $17.94 if you want to get picky here, $17.94. And that would give us then a total of $735.44. That would be then in 2000 and so that's 2014. So this would be in 2015, and so on. And this person, if they are still working at age 65, that's when they could opt out. They could say, no, I don't want to have this anymore, and they would actually notify the Canada Pension Plan through Service Canada. They say, no, stop taking this from me, and then both the employee and employer would stop once this person is not contributing to the PRB anymore. So this is going to affect a surprising number of people, actually, who sort of got caught in this. And now that it's become so easy to collect it at 60, and it's so much more common for people to keep working after 60, I would suggest we're going to see a lot of PRB going forward. It's still relatively new, and I think awareness of it at this point just hasn't caught on, but this is something that's going to have an impact. This is examinable, and it is something you have to be aware of for real-life considerations as well. I hope this helps. I hope you enjoy your ongoing studies. Thank you very kindly. Hi, and welcome back to the Business Career College video series. This is Jason Watt. In this video, we're going to be looking at some more detail around the Canada Pension Plan, and specifically what we're going to look at here are Canada Pension Plan disability benefits. Now, they're a hard benefit to access, but we do have to have some awareness of them, and one of the reasons we have to have some awareness of them, a lot of people are going to count on these and really have no idea just how difficult they are to collect. So that's the first thing we're going to look at, is our definition of disability here. So first off, you must be a contributor. You must be a CPP contributor in order to collect these benefits. And we define you as being a CPP contributor if you have earned 10% of YMPE in, we're going to look for 4 of the past 6 years. There's a little bit of a provision here for people who have a very long contributory period. If you have somebody who has a greater than 25-year contributory period, then you only have to have contributed in 3 of the past 5 years. That's a pretty narrow exception, but it will apply in some cases. And 10% of YMPE is not a huge amount of earnings. That's YMPE is typically, it's been historically for the last few years anyways, around $50,000 a year. So you're looking at least $5,000 of annual income roughly to qualify. But the really restrictive part here is not having contributed. It's that your definition has to be, or your disability has to be defined as being both severe and prolonged. So severe means that you're probably never going to recover, that you're probably unable to work as a direct result of your disability, and prolonged means that you're never going to recover. Now, there have been some administrative changes to Canada Pension Plan in recent years, and there is the potential here for somebody who has a serious disability, but one from which recovery might be possible to still collect this benefit, but it's going to be difficult. Now, once you do qualify for this benefit, there is going to be a waiting period or an elimination period. So you have a 4-month elimination period, or 17 weeks or 121 days. It is possible to collect CPP disability benefits in arrears to a fairly substantial extent, actually. I've heard of instances of up to 7 years. So if you do end up qualifying retroactively, it may be possible to get some CPP benefits retroactively. The benefit period, so your CPP disability benefit ends when the earlier of any of the following events happen. When you get to age 65, and that's when your normal CPP retirement benefit would kick in, or when you're no longer disabled, and I'm sure I don't have to indicate this, but this would include obviously somebody who has died, because then you're no longer disabled. If you do choose to start your CPP retirement benefit, which would be a really weird decision, I'll show you in a moment here that mathematically there's no circumstance under which you would be beneficial to take your CPP retirement benefit early, but the idea here is we don't want somebody collecting their CPP retirement benefit before age 65 and getting their CPP disability benefit, so we have to have a rule to prevent that. So now, how much is the benefit? The benefit is going to have a flat amount. This is right around $450. For 2013, the amount is $453.52. And then we're going to take 75% of your projected benefit. So of whatever your retirement benefit would be, so you have to go through and do the retirement benefit calculation, just like we did in an earlier video. So let's say that the orange person we used earlier, that's the person where we had adjusted their CPP retirement benefits based on having had some kids and so forth. So let's say that person becomes disabled, well, they would have a benefit of $453.52 for 2013. That amount will change in 2014, plus 75% times their $830 a month projected retirement benefit, and that would give you the CPP disability benefit. And that flat amount changes every year. This $453, it bumps up according to consumer price index each year, and this person then will have a CPP benefit also that will increase with the CPI, with consumer price index. That benefit will be, it'll be $1,076 a month, roughly. And like we've mentioned before, that amount will be taxable and it will be indexed to inflation. So it will grow every year to match with the consumer price index. And as you can see, it's a larger benefit than what the retirement benefit alone would be, which is why it wouldn't make sense to start your retirement benefit early. That would be a really weird decision. Now, one other thing that you might run into, this is a common sort of exam question, and it does happen in real life, mostly with group long-term disability, is we have what's called the CPP offset. This is a good concept to know anytime we're dealing with disability insurance anyways, and a lot of exam questions are going to use this concept. So the CPP offset says if you qualify for any CPP disability benefits, that you would have the potential to have your group disability benefit reduced. So let's say we have somebody who does qualify for a group long-term disability benefit of, how about $2,800 a month? So after their insurer realizes that their disability is going to be fairly serious, they'll actually compel them to apply. There'll be a contractual provision here if there is a CPP offset that says you have to apply for these benefits. And now this person, let's say, does qualify for that $1,076 a month from Canada Pension Plan. So now their long-term disability benefit would be reduced. They would now have a $1,724 a month LTD benefit, or long-term disability benefit. They're still getting their full $2,800. They're just getting it from two sources now, just from the combination of their group benefits and Canada Pension Plan. It's still a total of $2,800. Now, the more astute among you might have noticed that this does mean that the $1,076 from CPP is taxable, and generally, not always, but generally their long-term disability benefit is going to be tax-free. So we have potentially swapped out a tax-free benefit for a taxable benefit, but then the reality is that if that's your only taxable income, if you only have $1,076 of taxable income in a month, that's only going to generate about $12,000 of taxable income for the year. It's not enough that you're going to pay a meaningful amount of tax, and you probably qualify for the disability tax credit, which means that you probably aren't paying any tax at all, even though it's taxable income. So those are your CPP disability benefits. There are some important things to note here. The waiting period at 4 months is quite important. The relatively limited amount of benefit, $1,076, is a little bit more than the average. The average Canada Pension Plan disability benefit in 2013 is just a little bit shy of $900. So this person does a little bit better than the average. Note that it's indexed to inflation, that it's taxable, and the difficulty, the severe and prolonged definition here, which makes it quite difficult to claim. I hope that helps. Canada Pension Plan disability benefits are quite likely and possible to be tested, so you should have some awareness of them. In a later video, we're going to look at how dependent children can also qualify. The dependent children of a disabled CPP contributor can also qualify for these benefits. Thank you very much, and enjoy your studies. Hi, welcome back to the Business Career College video series. This is Jason Watt, and we're going to spend the next 10 minutes or so looking at the various Canada Pension Plan survivors and death benefits. Now, we're not going to look at benefits for kids just yet. We're going to put that in a separate video. So we're looking at the CPP survivors and death benefits. So these are benefits paid to those who are left behind when a CPP contributor dies. Now, the first thing we have to look at then is, what is a CPP contributor for this purpose? So we do have a very specific set of rules to define the eligibility for Canada Pension Plan. So what we're looking for here is that we have somebody who has contributed for at least 3 years. So we need to have somebody who has 3 years of contributions, or if they've been in Canada or contributing to Canada Pension Plan for more than 10 years. So if they've lived in Canada for more than 10 years, then they have to have more than 1/3 of contributions, or of their contributory period where they've actually contributed, or more than 10 years. So I know the math's a little tricky to follow here. I'll give you an example. So let's say that we have somebody who is age 30 and came to Canada, let's say at age 26. So this person dies at age 30, unfortunately, and we would look at that and we would say, okay, from 18 to 30, that's 13 years. 13 is obviously more than 10. That puts us in the second category. So then the question we have here is, did they contribute for more than 10 years? No, they didn't. Did they contribute for more than 1/3 of their contributory period? So they contributed for the years 26, 27, 28, 29, and 30. That's 5 years. 5 out of 13 would put them over that 1/3. They would qualify. If that were only 4 out of 13, if they had come to Canada age 27, for example, then they would have 4 out of 13, and that would be less than 1/3. Here they would not qualify. Okay, so once we know that they qualify, there are 2 sets of Canada Pension Plan benefits here. The first is a lump sum death benefit. And the lump sum death benefit is a maximum of $2,500. But not everybody gets $2,500. The actual calculation is 6 times what your projected retirement benefit would be. So 6 times your monthly retirement benefit. So most people today do qualify for the full $2,500. But there are occasionally people who have, maybe in the case of this person over here, relatively low contributions, and they might qualify for less than the full $2,500. This amount is really designed to help with the funeral. So it's going to be paid to the estate initially. If there's no estate, then it's going to go to the party who is handling the funeral arrangements in most cases. So then we have the survivor's benefit. The survivor's benefit's a little bit more complex. Not everybody gets it. So this is going to be for the spouse of a disabled CPP contributor, or sorry, deceased CPP contributor. This is a spouse or common law partner, and we're using the federal definition of a common law partner here, which is that they've lived together for more than 12 months in a conjugal relationship, or they're living together in a conjugal relationship and raising a child together. So there are really 4 different categories for this survivor's benefit, and it depends on who you leave behind. So we're going to look at the person who is left behind. Their benefit is based on the amount of benefit the person who died would have left. So we have 4 different categories. If this person is age 65 or greater, then they would get 60% of their deceased partner's benefit. However, there's a big restriction here. And the restriction is that this still only takes them to my survivors, so only up to the survivor's CPP maximum. So if you have somebody who's already maxed out on their CPP and they lose a spouse, they're not getting anything here. This only takes them up to their possible maximum. So if you've got a couple who retired together, who both contributed fully to Canada Pension Plan through their working years, there's not going to be a survivor's benefit there. Then we have somebody who is between 45 to 64, not yet 65, and there's a second group that fits in here, and this is under the age of 45, but meeting one of two criteria, and that is they're raising a child together, so under 45 with kids, or under 45 and this person themselves is disabled, meets the CPP criteria for disabled. And now what we're going to have is a flat dollar amount, and we're going to see that flat dollar amount again in a moment. And similar to what you saw if you watched the disability video already, then a percentage, and that percentage is 37.5% of the deceased's benefit. So we would have to do the calculation, figure out what their benefit would have been at age 65, take 37.5% of that, and add the flat dollar amount. As of 2013, that flat dollar amount is just shy of $177. It's actually $176.95, but 177 and 37.5% is sufficient for our purposes. And then we have another group of people. So now we're going to look at people who are under 45, and there are no kids. And this person's also not disabled. So it's the same benefit here. We're still going to do the same flat amount plus the 37.5%. But now it's going to be prorated downwards. So we take that and we're going to knock off 1/120th per month that this person is under the age of 45. So you die, you leave behind a 40-year-old spouse, for example. Well, we would say 40-year-old spouse, that's 5 years early. 5 years times, and you can do the math here, I'm sure this is not too difficult, 5 years times 12 months, that's 60 months. And so you would take off 60 120ths. So if you leave behind a 40-year-old survivor, then 60 120ths is half. That person is leaving behind half of this flat amount plus 37.5%. So we're going to just look at how much younger than 45 that person is. And then our last category of people, and if you carry through this math here, you've got this figured out already. So we're leaving behind somebody who's under 35, not disabled, and no kids. And here there's going to be no benefit. Now, in the bottom three cases, in each of the bottom three cases, once the survivor gets to age 65, then a benefit starts. So there is a benefit available at age 65. Okay, now whatever benefit you do have, remember, as with all CPP benefits, that it's going to be taxable and it's going to be indexed to inflation. And in a later video, we're also going to look at the benefits available for the child of a deceased CPP contributor. There's an additional amount of benefit that's payable there. So we see what's payable to the spouse here in forms of the lump sum benefit, which is relatively minor. But when we start to look over here at the amount of benefits, so flat dollar amount at 177 plus 37.5%, you're normally looking at a benefit between about $400 and $600 a month. That does become worthwhile, at least in terms of planning for the potential of that person's death. I hope that helps to understand CPP survivors and death benefits. A little bit complicated. There's some rules right at the beginning here that we certainly have to be aware of. For the most part, financial services exams aren't going to expect you to memorize all of these details, but it is useful to have a good level of comprehension, and especially to know what happens over 65 and under 35 when you leave behind somebody without kids. Enjoy your studies. Thank you very kindly. Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the benefits for the child of a CPP contributor. And there are two situations in which the child of a CPP contributor will get benefits. And those are if their parent dies. So we're going to look at if the contributor is deceased and leaves behind a child. And we're going to look at what happens if the contributor becomes disabled. They're both very similar. There's only a very minor difference really between the two, or one administrative difference between the two. So if we have a deceased CPP contributor, we're looking for the child to be either under the age of 18 or under 25 and a full-time student. And that applies also to the child of a disabled CPP contributor. Now, for the disabled only, for the child of a disabled CPP contributor only, deceased, I apologize. For the child of a deceased CPP contributor, we also have a benefit payable if this child is disabled. And the rules for this are a little bit complicated, but we're basically looking for a child who was disabled since before age 18 or since age 18 or earlier. In all cases, whichever of these three circumstances we're looking at, the child must be dependent. And the test for dependent is not what you might expect. It's an income test. So we're looking at the child's income. And this income has to be less than the basic personal amount, about $11,000, or if disabled, then less than the basic personal amount plus the disability tax credit amount, which comes to about $18,000. So we're looking for the child's income to be less than about $11,000, or if the child is disabled, and only if the child is disabled, less than about $18,000. And those amounts will change every year. They always are adjusted for inflation. So then the benefit amount here is going to be, as of 2013, currently $228.66 per month per eligible child. So you die and leave behind two children, you would leave behind a benefit of $228.66 per month. And as we are probably quite accustomed to now, this amount is both indexed and also taxable. And it would stop at age 25 or when the child is no longer a student, whichever. So when they no longer meet the criteria that they qualified for, the benefit ends, which of course makes a lot of sense. And we also have to recognize where this benefit is taxed, and it's taxed to the child. This becomes sort of an income splitting provision, especially if the child is a minor, in which case the benefit is paid to their parent or to whoever is taking care of them, their guardian or whatever you have, but always taxed to the child. Once the child is over the age of 18 and no longer a minor, 18 or over and no longer a minor, then the benefit is paid to and taxed to the child. So it's a relatively simple calculation. It's just a little bit extra here, and this can be meaningful. You die, you leave behind a couple kids, that's a couple benefits. A child could actually be collecting as many as two benefits if they had two deceased parents, or one deceased parent and one disabled parent, or two disabled parents, but no more than two benefits. I hope that helps to understand the Canada Pension Plan benefits for the child of a deceased or disabled CPP contributor. This is something that certainly shows up both in exams and in real life scenarios. Enjoy your ongoing studies. Thank you very much.
Hi, and welcome back to the Business Career College video series. In this video, we're going to look at coordination of benefits. Now, some of you might say, well, hang on, there's already a video on coordination of benefits. True, we're looking here at the coordination of benefits with respect to disability insurance, which is a similar concept to what you may have seen elsewhere with respect to coordination of benefits. Just that it's not quite so rigid, and we don't really have set of rules for this. Instead, we have contractual provisions, and there are some rules with respect to government programs. So what we have to see here is really, how does coordination of benefits work? I'm going to show you an example of how this would play out, and then I'll show you sort of the order in which coordination of benefits will happen. So let's say we have somebody who qualifies under an individual disability contract. So this person has individual DI and they end up with a claim, and the claim is generating, just let's say they have a face amount on their disability contract, so they're getting $3,000 a month of benefits. And that's initially what the disability insurer pays them. No issue here. After some time, remember that typically individual DI is going to have a waiting period based on what you purchased, but it might be 30, 60, 90, 120, 180 days, even up to 730 days in some cases. Let's say, just for the sake of argument, that we have a 90-day elimination period here, a 90-day waiting period. So this person waited this long and now they're getting this benefit, and of course that would be paid actually at the end of the month here, so they would probably be getting this on about the 120th day. Now, we know that it's quite likely, if you've got earned income, that you're also paying into CPP, and that CPP has its own disability benefit. However, you have to have a severe and prolonged disability, and this is very difficult to qualify for. Severe and prolonged disability basically means that you're probably never going to work again, or at least you're not going to work for a very, very long time, and that your income is substantially reduced, generally less than about $10,000 a year. So you've got somebody who qualifies then for CPP disability benefits. It has a 4-month elimination period, but it's actually pretty common for somebody to take a lot longer than that to qualify for CPP disability benefits, unless it's immediately obvious that this is a really serious disability. So let's say for a period of time that this person's been collecting the $3,000 a month benefit, and then ultimately they end up meeting the CPP definition here, the severe and prolonged. So they end up now qualifying for a CPP disability benefit, which would be about $1,200 a month. Let's say, for the sake of argument, that would be pretty typical. So what happens is the insurance company will actually recognize this. They say, hey, this person probably has a disability that's going to result in them being able to qualify for CPP disability. We're actually going to tell them that they have to qualify for CPP disability. This is very normal with contracts for individual and group disability insurance. So the insurer will now say, hey, you have to go apply for this benefit. If you don't, we're going to cut you off. And that's right in the contract. That's something that we assume is going to happen. On top of that, it wouldn't be uncommon to get your CPP disability benefits back to when you originally qualified here, and in that case the insurer will subrogate those benefits. That is, they will take those benefits because they'll say, hey, we were paying you a disability benefit, now you're going to basically get that made up to you. That doesn't make a lot of sense. So most, but not all, disability contracts are going to provide something like this, where you were getting $3,000 a month and now you qualify for CPP disability. So what's going to happen is the disability insurer says, no, we're done with that. We're going to pay you now $3,000 less this $1,200. So we're going to pay you $1,800 a month from your DI contract. Plus you're also getting the $1,200 a month from your CPP, so you're still getting your full $3,000 a month, just that now you're getting it from two sources. Now, one sort of side effect here is that the $1,800 a month that we see here, the amount from the DI contract, is most likely tax-free unless this was an employer-paid DI contract. The $1,200 a month here from CPP, that's taxable. In reality, that's probably not a big deal. If you're only making that $1,200 a month of taxable income from CPP, that's not going to put you in a position where you're going to actually end up paying any income tax. So now let's look at the sort of sequence or the order in which this happens. Now, this is more a set of principles than a set of hard and fast rules. So it doesn't necessarily always work exactly like I'm going to show you, but roughly here's how this breaks down. That most disability benefits will look to Canada Pension Plan as first payor. That is, if you're collecting a CPP benefit, that's the benefit that's going to supersede anything else. And then most benefits will look to WCB as first payor, except WCB looks to CPP as first payor. And then we have EI. Now, EI and WCB are sort of interchangeable here. Keep in mind, EI is a very short-term type of benefit, so it's not generally that big a deal as far as its first payor status. We then have a fourth source of benefits, one that we don't get too wrapped up in, but it actually does provide some disability benefits, and it is considered first payor by the next two types of contracts we'll look at. The next we have is any group benefits. So if you have your group disability contract, basically your group disability contract says, hey, first, are you getting benefits from an auto policy? If you are, we're going to reduce your benefits. Are you getting benefits from CPP? If you are, we're going to reduce your benefits. Are you getting benefits from WCB? If you are, we're going to reduce your benefits. If you're getting benefits from group, actually that's going to, though, reduce your EI. So this actually works in the opposite order, where EI would actually cause your group benefits would actually cause an offset against your EI. So like I said, it's not always perfect, the sequence, but that's roughly representative. And then, of course, the last payor for most types of contracts is your individual disability insurance contracts, which generally have provisions in them that say if you're getting benefits from any of these top 5 sources, we're going to reduce your income accordingly. There are some disability contracts that will say, for example, for the first 2 years, we're not going to have any offset against your CPP. So a lot of contracts will say for 2 years you can collect individual DI and CPP, but after that we're going to start that offset. So lots of different contractual provisions, and that's sort of the important thing to recognize here, is that this is in most cases contract specific, and that's where you do have to read your disability contract to know exactly what you're dealing with. That's very common with disability insurance in general. There's not a lot of sort of hard and fast rules that apply to disability insurance universally right across the board. Instead, almost everything we get into that's sort of the actual functioning of a disability contract comes very much down to that contract. I hope that helps. I hope that doesn't create any additional confusion. It is a fairly convoluted topic, and it's one that in real life really does have a lot of different possible iterations and outcomes, but having this sort of broad understanding of it will help you, and this will serve you well for exam purposes. Really, for exam purposes, the thing you're most likely to see is going to be this specific question, this CPP and disability contract type of question. So that's a very common type of exam question, and the reason for that really is because it's probably the most common real life scenario, and there is a fairly substantial actually body of case law and contract wording to back that up. So I hope that helps to understand how the coordination of benefits for disability contracts works. Like I said, a fairly complex idea simply because it works so many different ways from scenario to scenario, but this should help you to get through your exams and even to understand some real life scenarios. Thanks very much and enjoy your studies.